Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time.
Before we dive in, we are less than 24 hours after big Ohio State Oregon playoff win. Why I bring that up? Ben's a huge Ohio State fan. So, Ben, how are you feeling right now?
Yeah, this has potential to look really dumb because I don't know when this is coming out. But but as it stands right now on Thursday, January 2nd, in a great mood. Ohio State kind of firing on all cylinders offensively and defensively last night against Oregon in the Rose Bowl. They got Texas coming up in the Cotton Bowl. This is kind of the team we thought we were seeing all year, and it felt like at certain points the offense was clicking, the defense wasn't, and the defense was clicking, the offense wasn't. It feels like, at least over the last 2 weeks in the playoffs here, we've kind of seen both units firing on all cylinders, and it's been exciting. So, so far, I'm super happy, but again, this has potential to totally blow up in my face.
If they lose and this comes,
yeah, we could talk about NFL all day, but let's get into why we're actually here.
Okay, so we're gonna hit on, I've accumulated $10 million, whether it's just from saving, whether you've had a liquidity event in a business, however you got there, doesn't really matter. What we're looking at, I have $10 million. At the time of retirement, what does life look like? How much can I spend? What type of planning should I be doing? So Ben, any background, any context you want to give here?
Yeah, I really think of this, if you go on your 401k provider or a custodian that might be holding an investment account or an IRA, there's always a retirement calculator, and it always asks you to type in your net worth or your income or what you're saving, and it'll tell you when you want to retire, and it'll spit out just a big number. And a lot of people use that maybe don't have a financial plan or aren't working with a team to kind of get a ballpark number for what they need to save. A lot of people think they need to get to a certain number before they can actually retire. But there's so much context that goes into a number, whether it's, we'll get into all this, but, $10 million in retirement, that could be 100 times more enough than what you actually need, or it could be not enough depending on what your goals are, what you want to do with your legacy, and what you're spending. So I just want to frame that in mind because I think there's so much more to that conversation than just getting to a certain number, and I think we'll dive into why that's so important.
Yeah, for sure. We'll get into the numbers and the finance in a second, but let's set the stage with, like you said, there's no one-size-fits-all solution here. You can't just go plug this into a financial calculator. I mean, you can, but it's very specific. And I think if we were sitting down with somebody in this situation, one of the big focal points of the conversation would be, what are your goals? So really here, I would say most likely, if they've saved this, if they've just they're high income earners, they've done a good job saving, made some good investments, this is probably more than they'll need to spend because they've probably done a really good job accumulating. The best savers, the worst spenders. So it's really a conversation around, what do you want? I like to ask people, put these goals up against each other. So we'd say, number one, how important is it to maximize your lifestyle, your spending? Do we want to maximize as much as you possibly can and max out spending, or flip side, how important is legacy? Because those two things are going to kind of counteract. So a lot of times what we'll hear is spending's important and, legacy maybe is too. And when we look at it, maybe what they're actually spending is way under what they could and they're on track. Actually, let's flip that. Let's say spending's important, legacy isn't. They're spending way less than they think they could be, right, which means legacy is on steroids.
Yeah, we're almost grading them, right? We're saying, hey, your spending right now is probably a 2 out of 10, even though you just ranked it as the most important thing. And legacy planning, which you have indicated is not that important right now, is a 10 out of 10 based on your spending. You're on track to be leaving a huge legacy, even though you've dictated that's not a goal of yours.
And it could be the opposite. People could be overspending, but I would say in general, when we see the situation, this is what's common. So we want to get really granular around, hey, what are your goals here? What do we need to spend to maintain lifestyle? What are our bigger goals coming up? Do we want to buy a second house? Do we want to spend more on vacation? Do we want to fund grandkids' education? What does all that look like? And then kind of reverse engineer that back into what kind of legacy do we want to leave, and how do we do some estate planning to minimize a lot of the taxes. So what would you say? I mean, what do you think common goals are? What are less more on the goal side if we're getting into numbers, like anything that you hear regularly?
Yeah, for people that are like retired with this kind of net worth, a lot of it is making sure kids and grandkids are set up and okay. And that's a whole, we can do 2 hours on that itself. I mean, there's a lot of them want to help without enabling them. And I think there's a delicate line for how they want to do that. Grandkids, maybe it's helping fund education or undergrad, postgrad. If legacy is maybe not that important, shifting to spending, maybe it's getting a second home, maybe it's retiring in a city or maybe even a country that you've kind of always dreamed about. So again, those are really some of the main things that we're talking with a lot of retired clients in these scenarios about.
Yeah, and that's a good point. I would say I hear a lot of people that have accumulated the net worth in this range or higher. They say, it really depends, but a lot of times the kids aren't going to be as successful as they are. Maybe, the kids aren't, business owners, aren't like physicians. They're, and so they'll always say, we know our kids aren't going to probably get to this wealth range, so we want to make sure they're set up and help them. And that's a really hard thing to do because, like you said, you can help them to a point where making sure they're living comfortably, they're not struggling, but at the same time, you don't want to enable them. And the more you give and help, the less you can be incentivizing them to work hard and build their own wealth. So that's a really hard thing to get right. And there's a lot of stuff that, I'd say a financial advisor is going to talk to you about, what's your portfolio doing, hopefully how much you can spend. But these are the conversations that aren't had a lot of times, is how do we make sure that this wealth gets to the next generation without it just being spent.
Yeah, unfortunately, a lot of wealth doesn't get to the next second generation or the third generation.
Statistics, 70%'s gone by the second generation, 90%'s gone by the third generation.
Yeah, it's and like you said, that happens because these conversations aren't had, whether it's the retiree with the net worth isn't prioritizing what they want in retirement, so maybe they leave a huge nest egg with no planning to kids, and maybe the wrong estate planning's done, and it's a mess sorting that out, and then the kids have no real sense of how that money got to the parents, or they don't have any sense of how hard they worked to get it, and it can get spent, it can get lost, it can so yeah, like you said, the math doesn't show that wealth stays through the family.
We could talk about this section for 2 hours, like you said, but we'll hit really briefly. I think it's just important to, number one, have the conversations with the kids. You don't need to tell them how much money you have, but having conversations about money so they start to build the same habits and values, and then having the best thing you can pass to, in my opinion, to kids is your values, work ethic, how you got there versus the actual finances of it, so that they can do the same thing and not blow all the money. Like one client I work with, I'm thinking of, that is north of this net worth range. Kids are in college, and we've been very proactive to go build a relationship with the kids, meet the kids, talk to the kids about money, and just be friends with them so that they have a relationship they can go to. And when the time comes where they are getting this money, they're not just blindly inheriting millions and millions of dollars with no plan or anything.
Right.
So all of those conversations are important. But let's break down some of the finances, the numbers behind this. So let's assume you have 10 million, maybe you have 2 million in, it could be more, let's say 2 million in a pre-tax IRAs from 401ks, whatever, $1 million in Roth. And then in these situations, majority of your money is going to be in a taxable investment account, a brokerage account. So let's say in this scenario, 7 million's in a taxable account. So Ben, how much could this person spend? What's lifestyle look like, et cetera?
Yeah, I think comfortably, you could probably spend between $300,000 and $500,000 a year, just based on those numbers you just laid out. If that Roth number is higher, again, everything that comes out of the Roth is tax-free. So if that traditional, that number in the pre-tax account is higher, you got to worry about RMDs if you're over 73, and then ordinary income tax and any distributions. So again, super high level, probably right around 300 to 500,000 a year. You could safely
Take out
spend.
of it, yeah. Before we dive into more of the numbers, what would you say what are the biggest risks for somebody in this situation? They're getting ready to retire. They get $10 million. What could go wrong?
I would say health. Health's a big one. If you have 10 million, you're probably self-insured, but is that the most efficient way to plan for long-term care or medical costs? I would say not prioritizing your goals, kind of things that we talked about. Are you spending enough? Have you defined your legacy planning goals? If that's not defined, I would say that's a big risk. And I would say, taxes could be a big risk as well if you have a lot of money in pre-tax, or if you're not tax efficient inside of that brokerage account, you could be subject to additional tax that maybe you could have avoided.
Yeah, I'm going to dive a layer deeper in health. I think exactly what you said, making sure your insurances are in place and everything, or how you're going to cover that, but enjoying your money while you're healthy too. We've seen too many times where people will save a lot, they underspend, and then health goes, and they are never able to enjoy their money. So maybe setting up in the early years, if you're in your 60s and you still have your health, how can we spend this money, or maybe spend more money early on to enjoy it, and then taper back spending as you go through retirement. You get older and you're not moving as much. Maybe more money spent on healthcare and you're not traveling, et cetera. So I'd say, health's a big one. And then sequence of returns risk. So, making sure you're not taking this money when the market's down. You're well positioned that no matter what the market's doing, you have buckets of money you can pull from. And then, taxes and Medicare. So this situation, this example, we said there's not too much in a pre-tax IRA, but if that IRA is $5+ million, RMDs are going to be a big issue. You're going to be forced to take money out, get hit with higher tax rates.
And that's not super uncommon. If you've been maxing out a pre-tax 401k for 40 years, that IRA balance could be pretty large. And like you said, sequence of returns risk. So taking out money when the market's down. When you turn 73 in those types of accounts, you have to start taking money out, whether or not you want to, whether or not you need to. And so that's where we see a lot of plans not go awry, but just kind of hit a speed bump. Is when the market is down, you are forced to take a distribution, and that can cause some stress in the plan.
And your Medicare surcharge is based on taxable income. So when those RMDs kick in, let's say you have $5 million in a pre-tax IRA. What's 5% of that? 250.
Yeah.
250,000. You're forced to take out, and maybe you've been spending your brokerage account. You're spending a couple $100,000 a year. So let's say your income, until the RMDs kick in, if you haven't done any planning, is you're showing on your tax return $200,000 of income with Social Security and then dividends and capital gains from the investment account. Now you hit 73. You're used to spending that, and you're forced to take out another $250,000 that you don't need. That's a huge tax hit. Your Medicare costs jump up, et cetera. So all of these things, how do we avoid that? Roth conversions would be one way. Intentionally spending the IRA money early on in retirement when you can fill up those lower tax brackets. Other things like charitable contributions with the RMDs, give the money straight to charity, don't pay taxes. So all these things to consider in planning. But let's look at the numbers. So let's use those numbers that you said. Let's say you're 65. You have $10 million. Let's say Social Security is paying you $100. So we're going to take $400 out of the IRA, or $400 out of any of these accounts after taxes. Maybe it's $300, $350. So you're used to spending, let's say, $350, $400,000 a year, which would be 20 what? What is that monthly? 400. You're used to about $30,000, $33,000 a month. So if you just continued doing that, you took 400 out, that grew at 6% per year for the next 30 years. You're left when you're 95 with $25 million left. So the money's still, you're taking less than the return on the portfolio. So this is just like simple back of the napkin. We don't even need a fancy software to do this. back the napkin, left with almost $26 million. And some people will look at that and be like, well, that's way too big of a number. My kids don't need that much. So now we got to look at, okay, how do we maximize spending? So let's just increase this. If they were to take 500 a year out, and now that number's down to 17 million. At 95, we take 600 a year out. 600 a year out, you're left with your $10 million at 95. So that's basically how do we maximize living on the interest and not touch the principal. That's really a number. So all of these conversations, and I would say people probably don't spend that much money.
Yeah.
Like again, they've saved a lot. They've lived below their means. So it's having these conversations, and maybe we're doing some, I would say, training on how to spend the money that they're not used to spending. If legacy is not that important. But let's say that we are going to stick to that 400 number.
Real quick, before you move on, it's important to stress that we're still factoring in a 6% return, meaning, again, there's a misconception that once you're retired, you're moving all your money to bonds or you're putting so much money on the sidelines. Again, as long as you have enough safe money to withstand a certain amount of time that you're comfortable with, again, that doesn't necessarily mean that all of your money needs to immediately shift to bonds or to cash or to safe money. You still should have some equity exposure through your retirement. Again, 65, you could live another 40 years. You're going to need your money to support you, much longer than it would if it was just sitting in cash.
Yeah, exactly. A lot of the money, we'd want your next 7 years of spending in something safe, but beyond that, the money should be invested because we're not using it in the short term. But let's say we're on track to have that $25 million, $26 million left. Right now, the estate exemption is a little under $14 million a person. The way the tax law is written, that's going to sunset after next year. Could be extended with new administration, what we're thinking tax laws will look like. But let's say it drops down to what's proposed to $7 million a person. So of that 26, $14 million goes tax-free when you die to kids. The remaining $12 million gets hit at a 40% federal level plus state taxes. So in that scenario, $12 million times 40%, 4.8 million is going to the government. It's a big number. So Ben, what are common planning strategies we're doing to mitigate that or avoid the estate taxes?
Yeah. Like you said, if legacy planning is important, a lot of times we'll utilize our clients' annual exclusion. So you can gift $18,000 a year per person. So if
19 now. For
19 now, 2025. We're again January 2nd here. 19,000 per person. So that is, $38,000 if you're combining your gift with your spouse that you can gift to an individual. So if you have, 2 kids, 4 grandkids, that's 6 people that you can gift $38,000 to each. So you can really kind of maximize your gifting while you're living, and that's important for a couple of reasons. Number one, anything that you gift in that, as long as you're at that limit or below it, you don't have to file what's called a Form 709 or file any sort of gift tax return. So anything that you are gifting, you don't have to report. So it's kind of a freebie. And then you can also see how your kids, grandkids kind of react to the money. It's a good way to kind of teach them the values of money and kind of what they do with it. A lot of times we're funding kids or grandkids, IRAs or 401ks with that sort of money. Other estate planning tactics is just trust planning. So there's something called a spousal life access trust that kind of has the best of both worlds. We've done podcasts and we have numerous resources on this as well, but kind of almost a hybrid between a revocable and irrevocable trust. It is an irrevocable trust in nature, but it has some of the advantages of a revocable trust, meaning that a spouse is the trustee of the other spouse's trust, and so they can access it kind of through that method. So whether it's putting something like a life insurance policy, or if you have a private equity investment, kind of changing the ownership into a trust and utilizing gifting, those are things that we're doing to help people, because like you said, a lot of people feel like they don't have an estate tax problem because the limits are so high, but in 2026 those limits are scheduled to come down. So some people might not have an estate tax problem, but could in the next 5-10 years. So a lot of this planning is being done in the next few years, kind of before those exemptions come down, to make sure that they're utilizing them.
And I would bet, and again, it could stay in place for the next 4 years. I would bet that beyond that, it's going to be lower in the future. This is very high exemption limit, and for a number of reasons, probably will go down. So yeah, I think you hit it spot on. Lifetime gifting is a good way to get family members see how they handle the money now, and you can teach them, how to manage it properly. And then, trust planning is another thing, putting it into irrevocable trust, whether it's a SLAT or a standard irrevocable trust. Bottom line is just you're getting money out of the estate that's going to avoid those taxes. And that kind of comes into the spending. If you're well underspending what you could, we know there's going to be more left, so there's more opportunity to gift. On the flip side, if you're spending more, you don't care about legacy, this may not be as big of a conversation if you're just going to spend a lot of it. So yeah, a lot of estate planning that could be done in this situation as well. And then let's talk about asset allocations. I think common misconception, you Google, I'm getting ready to retire, I'm 65 years old, what's my asset allocation? You'll read being a 60-40 portfolio, 60% equities, 40% bonds. Super blanket advice. Good for some people, not good for everybody. You need something a little bit more specific. So in this scenario, if somebody was taking $400,000 a year out of the portfolio, we would want 7 years of that in something safe, bonds, cash inside life insurance, something that's not tied to equities.
And really think if you're spending $400 a year, maybe Social Security and maybe if you have a pension, maybe that's making up $100,000 of it. So really that gap is really
could be
$300,000 that you need. So it's even less, safe money that you need than maybe even think.
Yep. But in this scenario, if you're taking 400, 7 years of that would be a little under $3 million. So you could be ideally in a 70-30 portfolio. So you're more aggressive than you probably think. And if you're spending less, you could have even more bonds. But where we would want to position a lot of that. So number one, the Roth account, never want any bonds. We want that to be aggressive, passes tax-free. Ideally, that's the last money we touch. The IRA would be the first place we'd hold majority of the bonds. That's where we're taking money out. We know when you're 73, you have to take the money out, and we can intentionally fill up the low tax brackets. So first distribution account plus any of the bonds that pay interest or dividends. It's in a tax-deferred account. You don't get hit with taxes versus if it's in a taxable account. That's showing up on your tax return each year, and you're paying your marginal tax rate on that. So important to know where to hold these assets and what you should actually be invested in to make sure that we really put these guardrails up and bulletproof the distribution plan. Anything to add there?
No, it makes complete sense. And even the brokerage account that, again, maybe it's, direct indexed but that for tax efficiencies, but that ideally in an ideal world should be most all equities as well.
Yeah. Then we could carve off some cash or bond or municipal bonds outside of that if we wanted some extra liquidity outside of the IRA. Okay, well, anything we missed here? I think that's a pretty good overview of what life would look like.
Yeah, I mean, we can, again, making the most of the 10 million. So again, how to make that sustain. We talked about estate planning. We talked about Roth planning. I think the only other thing would be if you're charitably inclined, there's a lot of tax benefits to something called a donor advised fund. So maybe you've held stock for a long time that you're charitably inclined and you want to plan for it as efficiently as possible. You can donate it to what's called a donor advised fund. Think of it like an investment account that has to go to charity. And the benefit of moving low basis stock or stock that you've held for a long time is that you avoid that capital gain. Maybe you have $100 worth of stock, it grew to $100,000. You put all $100,000 in the donor advised fund. You avoid that $90,000 worth of gain because the charity receives it tax free. If you had sold the stock and then donated the cash proceeds instead, you'd be subject to capital gains tax. Plus, you don't get the immediate income tax deduction when you put it in. So, if you are charitably inclined, there's a lot of strategies out there. We've done various podcasts about that, but I think the donor advised fund for low basis stock, someone in this net worth range probably makes a ton of sense.
Yeah, donor advised fund could be a very easy, simple way to do that. QCDs, so taking your RMDs, giving them to charity, and then more advanced strategy, very specific, case by case specific, would be like a charitable, a charitable. It's called a CRAT, charitable remainder annuity trust. So you put money into the trust. You take. You have to take 5% out each year of income for yourself, but then whatever's left over when you die goes to a charity with kids on the kids on the trust, they're then taking that income stream and they're able to help manage it. So that could be another way. Again, more complicated. Definitely consult a estate planning attorney before you do that. But other advanced strategies that could be used for charity. Anything we're missing? I think that's a good overview.
No, I think key points. It kind of goes back to how we introed it. Was don't just think once I get to a number, I'm good. Before having these conversations of prioritizing what's most important, and making sure that you have all those goals laid out and prioritized. I think if you have that, then you can work towards a number or an age where you feel like you can be financially independent and start kind of implementing a lot of this planning.
Yeah, and I think too, be intentional before you even get here, because like I've heard a lot of people, like first time I meet a new client, prospective new client, they just say, I want to get to $10 million. So, okay, why? What are you going to do with that? Well, I don't know. It just seems like a good number. Well, maybe you're only spending $200,000 a year to maintain your lifestyle.
Yeah, maybe you don't need $10 million.
What's that $10 million doing for you? Unless you tell me there's a huge legacy you want to live, you want to increase spending, I'll challenge clients and say, like, you got to give me a reason. Or it's like, if you're used to spending $200, stop working way sooner and you don't need $10 million. So really just have some intention behind it and have these conversations before you even get there. Yeah, I think that's a good overview of what a $10 million retirement looks like. If you have any questions, feel free to reach out and catch us next week on the latest episode.
Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.